Oil is back on the rise amid ongoing concerns about tight worldwide supply. Yesterday, the United States imposed the first sanctions on owners of tankers carrying Russian oil, priced above the G7's price cap of $60 per barrel. At the same time, OPEC said it expects announced global crude stockpiles to slump by 3 million barrels per day this quarter, provided that there are no further supply disruptions emanating from the Israel-Hamas war. However, there is a rising risk that the conflict could extend beyond the borders of Israel and Palestine. Thus, geopolitics remains the key factor determining the movement of oil quotes. Also, OPEC kept its forecast for growth in global oil demand, citing signs of a resilient world economy and an expected demand recovery in China. Meanwhile, oil production in the United States reached a record high. Data showed that U.S. crude stockpiles jumped by over 10 million barrels last week. Speculation continues to influence the market. Brent crude is hovering in a range of 2.5%, and the asset briefly rose to 87.50 before falling back below the 85.50 mark. At the time of preparing this material, the benchmark resumed gains, approaching the key level of $90 per barrel. Such a chaotic movement indicates uncertainty among market participants who consider fundamental factors when making trading decisions. Speaking of gold, market sentiment remains bullish, which paves the way for a possible increase in the volume of long positions. Large institutional investors are clearly watching the developments of the Palestinian-Israeli conflict. If it widens with the other countries being involved, rising global risks will trigger a surge in gold prices. If the conflict subsides, the yellow metal will lose ground. As is the case with the oil, geopolitics is now the main driving factor in the market. The ruble pulled back a bit, trimming early gains. Its speculative rally held it at the level of 96.50, which allowed the dollar to recover by about 1.5%. This move is in line with the technical analysis. After all, there has been nothing new in the market since Russia introduced tougher capital controls. Despite the new rules, the Russian currency failed to rise to 95 rubles per dollar, apparently the buttress the ruble exchange rate. The government needs to take some other measures, possibly going beyond manual regulation of the currency market and manipulation of interest rates. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.